Have you ever imagined waking up to a surprise $100,000? A bonus, an inheritance, the sale of a business? Sounds exciting, until the real question hits you. Do you invest it all today or drip it into the market slowly over the next year? Before we go any further, make sure you like this video, share it with someone who needs to hear this, and subscribe to MANO INVEST, because today we're breaking down one of the biggest myths in personal finance. Most people will tell you the smart move is dollar cost averaging. Invest slowly, reduce risk, sleep better at night. It sounds responsible. It sounds cautious. It sounds mature. But what if that advice is quietly costing you thousands of dollars? Let's unpack it. If I gave you $100,000 right now, would you invest it today or wait? Here's the twist most people miss. Dollar cost averaging sounds smart. You spread your money out over months. If the market drops tomorrow, you feel relieved. You did not go all in at the top. You avoided looking foolish. And that emotional protection feels powerful. But let's slow this down. When you dollar cost average, a big chunk of your money sits in cash while you wait. It is not growing. It is not compounding. It is just watching from the sidelines. Historically, markets rise more often than they fall. That means most of the time, the earlier your money is invested, the more time it has to grow. Time is the real engine of returns. Not timing, not comfort, time. Dollar cost averaging reduces the pain of a short-term drop. That is its true purpose. It protects your feelings. But investing is not about feeling right next week. It's about increasing the odds over years. So the real question is not, what if it crashes tomorrow? It's, what if it keeps going up while I wait? And that question makes this decision much more uncomfortable. What if I told you the safe investing strategy most people use is wrong 70% of the time? Here's the math nobody talks about. The stock market, measured by broad indexes like the S&P 500, has historically finished positive about 3 out of every 4 years. That means most years prices end higher than where they started. Now think about what happens when you spread your investment over 12 months instead of investing it up front. You're quietly making a bet. You're betting that a downturn is coming soon, that prices will fall in the near term, giving you better entry points. But statistically, that bet fails more often than it wins. While you wait, your money sits in cash, cash that loses purchasing power to inflation, cash that earns little, cash that does not participate in growth, and the market doesn't pause for your comfort. Wealth is built on compounding. Compounding only works on money that is actually invested. The longer your capital is exposed to growth, the more time it has to multiply. Delay the investment, and you delay the engine. And here's the part most people miss. Even small delays can have large long-term effects because growth builds on growth. So the real question isn't, what if I invest before a dip? It's, what is waiting actually costing me? And that cost is rarely obvious in the moment. If you wait to invest, you might be paying a price you never see. Here's what I mean. Imagine you receive $100,000 and decide to spread it over 12 months. Sounds responsible, right? Slow and steady, lower stress. Now imagine the market rises steadily during that year. Not a crazy bull run, just a normal, gradual climb. If you invested everything on day one, your full $100,000 would be growing the entire time. But if you chose dollar cost averaging, most of that money would be sitting in cash for months, maybe $80,000, maybe more. And cash doesn't compound, it waits. Here's the part people miss. When the market goes up while you're waiting, that growth is gone forever. The market doesn't rewind and give you a second entry point because you are being cautious. It keeps moving. Historically, markets trend upward more often than they do. That upward drift is quiet but powerful, and the longer your money is invested, the more time compounding has to work. So the real question isn't if it invests before a drop, it's missing the climb. Before you default to playing it safe, ask yourself one question. Are you avoiding short-term discomfort or quietly sacrificing long-term growth? What if I told you the worst investing mistake isn't buying before a crash, it's waiting because you're afraid of one? Picture this. You invest a large lump sum today. Next month, the market drops 30%. Your portfolio shrinks. Headlines scream, Twitter panics. In that moment, dollar cost averaging looks brilliant. You feel like you dodged a bullet by not going all in. But zoom out. Historically, after major drops, markets have recovered. Not instantly, not comfortably, but consistently over time. And here's the part most people miss. The investor who put their money in early often ends up ahead within a few years. Why? Because they bought more shares from day one. When prices fall, those shares lose value temporarily, but when the market rebounds, every single share participates in that recovery. If you invested $100,000 up front, all $100,000 was working the entire time. With dollar cost averaging, a large chunk of your money sits in cash waiting for safer entry points. That cash doesn't grow, it doesn't compound, it just waits. Think of it like buying an entire apartment building right before a short recession. Property values dip, rent slows, it feels uncomfortable. But when the local economy recovers, the person who owns the whole building benefits from every unit. The investor who bought a few apartments slowly, they participate, but on a smaller scale. Scale matters. Exposure matters. Time matters most. Yes, dollar cost averaging can soften the emotional blow of a crash, but markets spend more time rising than falling, and the longer your money is invested, the more recovery power you capture. So the real question isn't, what if it crashes next month? It's, what if it doesn't? And if the bigger risk isn't volatility, but missing time in the market, what does that mean for the cash you're holding right now? If you need this money in 3 years, investing it today could be a mistake. If you need it in 15 years, not investing it today could be the mistake. That's the real decision most people miss. When you receive a windfall, the debate usually becomes lump sum or dollar cost average. But that's the wrong starting point. The first question is simpler and more powerful. When do you actually need the money? If you'll need it in the next 3 to 5 years, the stock market is not your playground. Markets move in cycles. They rise, they fall, and sometimes they stay down longer than you expect. Short-term money belongs in safer places like high-yield savings, money market funds, or short-term bonds. The goal there is stability, not growth. Now let's flip it. If this money is for retirement or a goal 10, 15, even 20 years away, everything changes. You are no longer trying to avoid temporary dips. You are trying to maximize long-term odds. And historically, over long periods, markets trend upward, not in a straight line, not comfortably, but consistently over time. The longer your horizon, the more those short-term drops start to look like noise instead of danger. This is where discipline matters, because your brain wants comfort, it wants guarantees, it wants to avoid regret. But long-term investing is about probability, not comfort. If your timeline is long enough, getting invested sooner often means giving your money more time to compound, more time working, more time growing. So before you ask, should I invest it all now? Ask yourself something better. When does future me actually need this money? That single answer might make the decision obvious. And here's something most people don't consider. What if the real risk isn't investing too early, but waiting too long? What if your safe investing plan is actually costing you money? Let's say you just received a large amount of cash, bonus, inheritance, business sale. You know it should go into the market, but the idea of investing it all today makes your stomach tighten. So you hesitate. Most people respond by spreading the investment over a full year. It feels responsible, it feels cautious, it feels smart. But here's the problem. Historically, markets trend upward more often than they fall. When you stretch your investment over a year, a big portion of your money sits in cash, while the market potentially climbs without you. That delay has a cost. Your money is not compounding, it is waiting. Now, I'm not saying you must go all in immediately if that makes you panic. Emotions matter, because if you can't stick with a plan, the math does not help you. This is where the smart compromise comes in. Instead of 100% today or 12 months of hesitation, split it. Invest 50% immediately. Put it to work right away so it starts compounding. Then take the remaining 50% and invest it over the next 2 to 3 months on a fixed schedule. No guessing, no reacting to headlines, just a short, defined runway to get fully invested. Not 12 months, not "I'll wait and see," just a brief transition. This way, most of your capital benefits from the market's long-term upward drift, while you still reduce the emotional shock of going all in at once. Because here's the truth most people miss. Stretching your investment over a year often isn't strategy, it is fear wearing a tie. The real question is not whether you can avoid short-term volatility. It is whether you are willing to accept the long-term cost of sitting on the sidelines. And that trade-off is something most investors never fully calculate. What if the safe move with your money is actually the thing making you poorer? Most people think building wealth is about avoiding mistakes, waiting for the perfect entry, sitting in cash until the headlines calm down, feeling certain. Here's the uncomfortable truth. There is no perfectly safe way to build wealth. The market does not reward hesitation. It rewards participation. Let me explain. When your money is invested, it has a job. It earns returns. Those returns earn returns. That process is called compounding. Over time, compounding turns steady growth into serious wealth. But when your money is sitting in cash, it is not compounding, it is idle. And while it waits, inflation quietly reduces what it can buy. Even a modest 3% inflation rate cuts purchasing power in half over a couple of decades. That is not dramatic, that is math. Now here's the pattern most people miss. The stock market has historically risen more often than it has fallen over long periods. Not every year, not smoothly, but directionally upward. That upward drift is what long-term investors rely on. So when you delay investing long-term capital because you want to feel safe, you are making a trade. You are reducing short-term emotional discomfort in exchange for lower long-term probability of growth. Wealth is not built by perfect timing. It is built by time in the market. If you have money you won't need for 10 years or more, the highest probability strategy has historically been to invest it and stay invested, not because it feels safe, but because the odds favor disciplined participation. The real risk is not short-term volatility, it is spending years on the sidelines while compounding happens without you. So here's the question, are you protecting your money or protecting your feelings? Because those two are not always the same thing. If this video challenged something you've always believed, hit like. If you want clear, data-driven investing insights without the noise, subscribe to MANO INVEST. And share this with someone who's sitting on cash, waiting for the perfect moment. Because in investing, perfect timing is rare. But disciplined action, that builds wealth. I'll see you in the next video.